As we're now getting into the body of the DCF analysis, I thought it'd be timely to go over the requirements for the data, and especially to look at some of the forecast requirements and so on. So that's going to be the topic we're going to be looking at now. We've mentioned before that the property has no debt or tax if we're looking at the property itself. So we're looking at it from a valuation point of view. We simply look at it quite independently of the investor. And so the only data is what really pertains to the property itself. Now, we're going to be looking at it from the point of the investor, and so we are going to be putting in the investor's situation. To begin with, we're going to look at debt, but in the next modules, we're going to be looking at taxation as well. When we look at the investor's situation, we really want to get an idea of what decisions the investor is likely to make in deciding whether or not to take the investment. This doesn't necessarily change the investment itself, but it does change the investor's inclination to buy it. And so we're wanting to look at the net financial benefit to the investor. And really this is what determines their bids in the marketplace. And I think this is really quite a valuation issue for those of you who are valuers. Is valuation related to the psychology of the investor or the purchaser, or is it something totally in the property itself? To a certain extent, that answer is not really clear-cut. Officially, we like to think of value as being in the thing, but when we look at supply and demand, really we're looking at the psychological inclinations of the players. We're not going to be looking so much in this course at the idea of property as part of a portfolio, but you can use the same methods, the same basic approach, the DCF approach, to look at a portfolio of investments. And if you are looking at a portfolio of investments, the DCF is actually also a very powerful tool. Some of you might like to give some thought to the way that a multi-tenanted building is in fact, at least in some respects, a property investment portfolio in itself. Because really you have different tenants who have different profiles and maybe different preferences and business situations, and so the risks on each tenant tends to be moderated when you have a large number of tenants. When we come to talking about portfolio theory, it might also be useful for you to think back to maybe a shopping centre or something like that, because as well as this supposed independence of the different investments, if you think of a situation where, let's say, a couple of tenants fall over and default in a shopping centre and you end up with a couple of vacant spaces, that can have an effect on the other tenancies and in fact make their business less viable as well. We actually find this in general portfolio theory. We're probably getting ahead of ourselves a little bit with that, but I'd like to just keep that in mind, that the idea of the independence of investment performance is in fact a little bit of a myth, because in some ways when one investment or set of investments is a bit rickety, it tends to make the rest of the investment world also unstable. Now, with the investment appraisal model that we're building, once you've finished the model, if you take a step back from it and look at it, you'll see that except for the initial cost and the initial revenues and expenses, everything else is a forecast. And so this really underlines the importance of strong forecasting. The problem is that forecasting the future is extremely difficult. And in fact, so far, at least as far as I'm aware, no one has been able to do it successfully. While things are going well, the best indication is that they will continue to do well. Except we also know from experience, and especially the way that business and finance worlds tend to move in cycles, that while through most of the cycle, if things have been booming last week, they'll probably be booming next week. And that carries through for most of the boom period, except for when things turn. And when things go badly, then things are going to continue to go badly. So if last week it was depression, next week will probably be depression. However, at some point that'll turn again. So there's this curious fact that when we're looking at forecasting, the past is a very good indicator of the future, except when it isn't. And while the exceptions are less numerically than the past is equal to the future, or the future is a continuation of the past kind of thinking, it's those turning points that really make the difference between financial success and ruin. When we look at the practicalities, though, we have to perform forecasts for just about everything in our model. Certainly for our revenues and expenses, we also need to be doing forecasts for our eventual sale income. And that means the better the estimates are that you do, the more reliable your DCF appraisal model is. The only problem, of course, is that you never get to know how good your model is until after it's too late, until after you've bought the investment. However, we'll have to aim to do the best we can. But what we need to do now is look at how to get the best forecasts of our revenues, expenses, sale incomes, also what we're going to do for escalation rates and yields and so on. And eventually we're going to talk about our discount rate. The rents in our property investment are they can be quite complex. We're looking specifically at the passing rent. That's the actual dollars that are coming in, not the notional rent that might be in the lease, because you might have things like incentives and other situations. It's important to read the lease to find that. With the rent, we also have to take account of the fact that different specific property investments will often have different peculiarities in the way that their leases are written. One of the more significant ones is in retailing, where it's not uncommon now for the retail lease to be written so that the landlord takes a fraction, a percentage of the turnover. And so you have a base rent and you have a turnover rent, and you have to read the lease fairly carefully to see how those two interrelate. When we're producing our DCF model, we also have to consider anything else which might put lumps and bumps into the rental income stream. This can include specifically or especially your vacancy, but it also includes other things like incentives. And while the incentives are often not specified numerically, something like doing a fit out for a tenant, we have to estimate exactly what that will be. We can have the other revenues. We've already mentioned signage and used that as an indication of the other property rents that can come. We've mentioned mobile phone towers and so on. But there's actually quite a few, and so you've got to be aware of all of the sources of revenue. The different revenues will follow different patterns of growth into the future. We've been using one generic growth term, which is the property growth rate, which we're calling it, and that can be fairly suitable for a lot of forecasting purposes. However, it's useful to be aware that different parts of the property market may follow different growth rates, and especially when they're tied to third factors or external factors, such as the health of the retailing industry. If we've got part or all of our property is tenanted by retailing tenants. So we need to be aware of these various industries and so on. To find our information, well, for domestic residential investments, that's fairly straightforward because it's fairly accessible through your local real estate agent and so on. Also, you'll find data sources like RP data extremely useful. There's also a wealth of information on the net, not just for property investors, but also organisations that run commentaries on the property market, such as the larger property organisations, Jones Lang LaSalle, that sort of thing. You can look at the AMP, the National Australia Bank, Westpac. Quite a few large organisations provide sources of data. Oh, don't forget the Reserve Bank of Australia and the Australian Bureau of Statistics as well. Overall, it's important for you to be taking an interest in keeping up to date with where this various data is going and what the commentators are saying. When we look at expenses, again we can look at the domestic investment, say a housing investment, a dwelling investment property, and that really gives us most of the major categories. So we're going to be looking at maintenance, utilities, management, insurance, rates and taxes, and perhaps an allowance for capital expenditure. Now the complexity that you go on to with those, it comes partly from experience, partly from talking to people, partly from whatever experience you've been able to pick up along the way. There are general rules that you can follow or norms that give you an idea of about how much your local government rates are going to be and that sort of thing. Again, experience is probably the best teacher. For our assignment, you'll be able to find a lot of this information simply by talking to people that have had some experience with residential properties, so that tends to be fairly accessible. When we look at expenses, for commercial expenses, we need to be able to distinguish between those expenses that the landlord has to pay and those that they're able to pass on to the tenant. So these are recoverable and non-recoverable expenses. The recoverable expenses really don't concern us a great deal because while we might be paying them, we end up getting a payment from the tenant, and so it's cash coming out of our pockets but also cash coming into our pockets, results nil. So it's not that important. The non-recoverable expenses are important to estimate though, and knowing exactly what your non-recoverable items are for residential investments, things like rates and taxes, usually paid for by the investor, and so they would be considered as non-recoverable, whereas things like electricity costs and so on are recoverable because they're used by the tenant and paid for by them. We also have to look at the growth patterns. Now, while we can again just rely on the property growth rate as a bit of a catch-all, we have to be aware that there are other patterns of growth as well, and we'll be talking about those a bit later. In terms of data sources for the expense side, again it comes down to market knowledge. Just about everybody lives in a dwelling of some sort, and so typically you'll be able to look around and either ask people who have been taking interest in this or your own experience to look at what levels of maintenance are typical, and when we look at the investment property that you're selecting, you can do an estimate of what you consider to be a reasonable estimate of maintenance. In practice, investors will be refining their estimates as they get more experience, and so the maintenance costs from this year can give you an idea of what the maintenance costs are likely to be next year and so on. And as you're starting to look at the paint slowly fading and peeling, you've got an idea, well, every 5 or 10 years or what have you, you have to get somebody out there with a paintbrush or what have you. So getting an idea of the recurrence intervals is important. The lease itself is also an important source of information because that enables you to be able to split between recoverable and non-recoverable expenses. By now you'll be seeing that the notional end sale is vitally important in your model. All DCFs must capture all cash flows connected with an investment. And so even though we might be only considering the model to run for 5, 10, 20 years, we still have to consider that cash flow that comes at the end, which is when we sell the property. It's good to always keep in mind that the financial value of a property has been defined as the present value of its future rents. And in a way, that notional sale is a way of capturing the future rents that happen after the end of the investment period, because that's still a benefit. And so the notional end sale is very, very important, especially because property is considered to be a perpetual asset which will always be earning some kind of value. What we do in practice is either grow the purchase price simply by the property growth rate. That gives us a reasonable estimate. The more precise approach is to capitalise the year's income following the expected year of sale. This causes us also to think about the way that we're making some assumptions as to the timing of the cash flows. In our DCF model that we're doing at present, we're assuming that all of the cash flows, the revenues, the expenses, the end sale and so on, each one of those happens neatly at the end of the period, the year if you like, that we're considering. And so the rents for year one and the expenses for year one are all anticipated to be received and paid at 12 months' time. The revenues and expenses for year two, again, are considered to be a notional single cash flow at the end of the second year, and so on right out to the end of the appraisal period. What that means is that the very last cash flow that happens at the end of the last year of the model includes the revenues, the expenses, and also the notional end sale. If we're going to work out what that is, if we put ourselves in the shoes of someone considering buying the property at that point, they will be capitalising the year following its income or its net operating income. And so we have to model 1 year past the revenues and expenses to get the net operating income for the year following the year of sale. Puts a little bit of a wrinkle into our models. By now you will have seen that demonstrated, but it's important to be aware of why it's important. Of course, that's all a bit more complicated than the simple approach of growing the purchase price following the property growth rate worked on the sale, the purchase price. The approach of capitalising the year following the year of income enables us to consider a number of extra variables. It enables us to consider the situation where the yields might be changing over time. It also enables us to look at perhaps cycles running through. And so while we're assuming that there's a single property growth rate between now and the next 10, 20 years or something, you can build your model so that you can input a separate growth rate year by year by year. And that is the advantage that if you strongly believe that there's going to be a property cycle happening, where there's going to be some boom years and some depression years, then you're able to put that into your model. And of course the property value then sort of follows on from that. That understanding of the long-term growth patterns of property values compared to the long-term pattern of rentals is an important separate study, which is a little bit beyond the scope of what we're doing in this course, but it's good to be aware that property doesn't necessarily grow at the same rate that rents grow. In boom times, property values rise far quicker than rents do. It takes rents a while to catch up. It's important, therefore, to be able to moderate our expectations so we really are catching what is truly representative of the kind of trends, if you like, in the property. Because we're looking from the investor's perspective, we have to consider the debt parameters, the financing parameters. We're looking at a fairly simple financing arrangement consisting of a single loan. In particular, we're considering not the typical mortgage that the average mum and dad get themselves into when they buy a house. We're looking at interest-only loans. The reason for that is that from an investment point of view, it's a lot more efficient to take an interest-only loan. And the reason for that is that with the time value of money tending to help you, if you borrow $1 million today, if you intend to pay that back in 10 years' time, that $1 million isn't going to be worth the same as it is today. So you'll be paying back that $1 million with cheaper money 10 years into the future. And so it's an advantage not to be paying it off along the way, because if you pay it off with interest and principal progressively over the 10 years or even the 20 years or whatever, you're paying back the principal initially with these more expensive dollars, and that's simply not good financial sense. And so we tend to recommend using interest-only loans. There are also considerable advantages with the interest-only approach, and that is that all of your debt servicing costs, all of the payment that you make back to the bank, is all tax deductible. And that is considerably tidier to calculate, but it also optimises the tax advantages you get from your investment. and tax advantages tend to be very, very important in property investment considerations. In some cases, investors may want to use more complex debt than we're considering here. Here we're only considering one mortgage, one loan. In some property investments, especially in property development, it's not uncommon to use more than one source of debt. In particular, there is a type of debt called mezzanine finance, which is debt loan which is borrowed in addition to what you can get from a regular bank. It's more risky. There are ways of making it more of an incentive for the lender, such as offering the lender a share of the profits, especially if you're using it in some very profitable activity such as property development and so on. It's just an example of more complex debt. Generally, when we have more than one form of debt, we refer to it as structured finance or structured debt. And this is where we use two or more sources of debt, often with more and more complex arrangements of interest costs and other advantages and disadvantages for the respective parties. While we're looking at debt, we have to look at the question of interest rates. Now, most of you will be aware, especially if you've done some economics at school and taken interest in the economy ever since, that the Reserve Bank is changing or considering interest rates on a very regular basis. However, the community at large is never really sure of where the RBA is going to go with interest rates. There'll be people thinking they're going to go up, people thinking they're going to go down, and sometimes they just stay put. What's the answer there? Well, what we can take from that is that forecasting interest rates is really quite challenging, because we really don't know what dynamics are going to be affecting the thinking of the decision makers, especially the Reserve Bank in Australia. But forecasting interest rates is something that we definitely do have to do, because they're an important parameter within our model. So one way or another we have to make some sort of a guess. Now, where do we get our ideas from to make that estimate? Well, we have to be up to date with what people are saying, especially those people whose opinion is respected or who are in positions where their opinions might easily be turned into policy. And so it's good to read through the speeches by the chairman of the Reserve Bank from time to time and keep up with what the RBA is saying to Australia through their newsletter and other publications. Likewise, there are a number of other commentators who like to second guess what the RBA is doing and so on. And one way or another, getting as broad a feel for this as you can certainly won't hurt. There are a few other parameters that are worth being aware of, usually when we're looking at more complex investments. So things like, what are the other costs involved in debt? What are the strategies related to the way that the money is borrowed? Is it all borrowed all at once? Is it borrowed in a number of bites, say for a construction project or something? How are those access to the progressive drawdowns, the progressive borrowing up to the principal? How are they costed? Are there any extra charges for having that facility to be able to pay back or draw down your loan progressively? You also have to look at what conditions there are in the loan as far as how the loan is paid back, how it is amortised. In some cases, loans have very strict rules where once you've borrowed money, you have to stay in that situation no matter what, or there might be some very structured plan for how the money is paid back. It's important to be aware of those because they can get into our models, because they do affect the cash flows over time, which is fairly obvious. The most important single variable is the discount rate. It's most important because if you change the discount rate, the whole dynamics of the model, the future value of money and all that, all changes, and so your net present value and the value of the property changes. And so it's an extremely important variable. However, it's also one of the most challenging to estimate. And this is quite a puzzle for students. You can read about all the fancy DCF stuff in your textbook, when you come to actually do one using a real world case study, you suddenly discover that the discount rate is the really most important number after you've gone out and looked at valuing your improvements and doing this and that, reading up on the RBA's plans for interest rates and whatnot. The discount rate, where does that come from? Well, ultimately the discount rate is the subjective preference of the investor. It's what rate of profit the investor will require in order to bother investing in the particular investment. And so ultimately it's rather subjective. However, there are a few hints and pointers that we can use. It's easily, almost apparently, that it can be derived by comparison with other possible investments. And so if your investor is considering this property versus that property, and we can work out a discount rate for that property, then you can import that as the expectation for the subject that you're looking at, you're analysing. Also, you can look at the comparisons between the property returns and other returns. What's property investment returning, say, in general compared to government bonds? And by looking at this comparable approach, you get a fair indication of what rate of return is going to be appropriate when you're analysing your property. Two factors that are important is the risk and return balance, if you like. As risks increase, then the expectation of return increases. The most formal presentation of that in finance is a rather elegant method for relating different investment opportunities, what we call capital asset investment model or investment opportunities, and that gives rise to what's known as the capital asset pricing model. And the capital asset pricing model, CAPM, is no more than a simple graph that relates the return of an investment as a function of its risk, and has the lovely advantage of being able to connect different risk investments, say government bonds versus private equities, property, different types of property, say property investment, property development, and so on, all into one graph of risk versus return. So getting familiar with the capital asset pricing model, or maybe dusting off your notes if you've encountered it in a previous course, is very, very useful. However, you really can't take the CAPM model too far, because it also has a number of critics and only works in general terms anyway. And the really big trick is getting a clear understanding of how to quantify risk. However, risk versus return is worth thinking about, even if the CAPM model is not quite as precise as maybe an engineer or a scientist might expect. Another source of discount rate comes from the capital costs of the organisation that's buying the property. Often property isn't bought by individuals but by companies. If we know what the profit expectations of that company's shareholders are, and we have an understanding of their capital structure, how they get their money, whether it's through equities, as in shares, or debt, or a combination of, we can work out from their balance sheet and an understanding of their capital structure what return the company needs in order to be able to meet its business objectives. By using this estimate, you're then able to work out what hurdle rate, what rate of return any particular investment that the company takes on must be able to achieve. And so if the shareholders and the creditors of the company, by the time you connect those together or analyse them together using something like a weighted average or a weighted mean, you're able to then say, well, any investment that this company takes on must be able to exceed the return on that weighted mean. So the weighted average cost of capital is an important theoretical tool for working out the discount rate. Unfortunately, estimating or evaluating the WACC is not quite as easy as it looks in practice, and often companies will want a premium on their WACC number in order to make sure that they've got some kind of comfort in there for your risks. Overall, what we have to conclude is that the discount rate is ultimately subjective, And now we're seeing more and more, certainly for commercial investments, the comparable investments are being analysed back to yield a discount rate. And so that's useful because the property analyst is then able to adopt the discount rates that are analysed back from comparable sales, which tends to solve a lot of the puzzles, so you don't have to worry about the WACC or the CAPM model or what have you. What it's really doing is looking at what other investors are expecting as a return for comparable investments. You can't actually do that for residential property because the market really isn't set up for the investor with that level of sophistication. There are a number of other factors that also have to be estimated. You have to look at the various escalators, in particular inflation, capital asset, the consumer price index. However, don't rely too much on inflation. There are a number of different specific escalators that are probably more appropriate for the property industry. In particular, the property growth rate affects anything which has a price which does follow the property market, such as property management fees, rents. A lot of your expenses will follow that. However, the others include not just the inflation rate, but also things like the building price index and local indexes. So the building price index and in fact the CPI all vary differently depending on where you are. So if you're in regional Australia in a particular location, in a particular state, that might be different to a different state in, say, a capital city or something. We don't initially consider the investment period as being a critical variable, but in fact it is. It's worth your while analysing your investment by looking at how it performs for different periods of ownership. It's common in Australia at present to analyse properties using a 10-year investment period. There are a number of reasons for that. It's a nice round number. There is a belief that property investors hold property on average for about 8 to 10 years. There is some criticism as to whether that number is actually true. However, 10 years is a nice number. If you try estimating over longer periods, you really have to ask yourself the question, are my forecast parameters really that reliable? If I can't guess what the RBA is going to be charging for interest rates in 6 months' time, how can I put an interest rate estimate in for 20 years into the future? And all of the other variables suffer the same problem. So we use the 10-year time frame as the common analysis period. That's not to say that others, such as the life of the building or the life of the project, and so if you're looking at a mine or a factory, it might be intended that that factory might have a particular design life, and so we could reasonably do our DCF over the expected design life. We look at things like building life cycles and things like that. Related to getting our period right is also the importance of looking at the sensitivity of the results to the length of ownership. If it turns out that our property works if I hold the property for 5 years, it doesn't work if I hold it for 10, or vice versa, and that will be saying something about how robust my investment is. One tool that you can use to overcome this sensitivity to the analysis period is the annual equivalent at net present value. And that's simply the net present value divided by the holding period.